National Insurance Clearinghouse, the marketing arm of Brokers Alliance, presents a Bravo video event, the Business Insurance Zone, dedicated to financial professionals who use insurance in their practice. And on today's show, Index Annuities with Index Annuity expert Sheryl Moore. And now the host of the Business Insurance Zone, the whiz of the biz, insurance columnist Steve Savant. Well, welcome everyone to the Business Insurance Zone. I'm Steve Savant, your host, and we're broadcasting live to a nationwide audience of insurance professionals right out of here at Fountain Hills, Arizona, home of America's largest fountain. And with me today, day 3, and if you're not freaked out by the first 2 shows, this is going to even put you over the edge. Day 3 with Sheryl Moore, industry expert on indexing life or annuities, but all this week, annuities. And yesterday, when we found out again that probably if you're going to hold for 10 years, cap spreads and participation rates may be kind of irrelevant to break them out like that. And then on top of it, Sheryl decides to go, well, if you're going 5-year point-to-point or annual point-to-point or monthly, or you're doing daily sweeps, maybe that's not that big a deal, right? As long as you're holding it for a long time. So we're decrypting a lot of things. Now, I do want to get into a little bit of indexing today on the domestic and foreign. But before I do that, after going through 2 shows with you, I'm looking at the trust factor on all this now. Mm-hmm. I'm trying to deal, I go out to your site, I look at your policy provisions that you've collected on Annuity Specs. I'm looking at it, and I'm just trying to trust the carrier issue on, hey, what's the reset going to be? What's the cap? You're going to change it. The renewal rate? Yeah, this is the thing that's about, this is the thing that I go, it's a first year bait and switch issue, and most carriers, right, we want to know who are the people, and not so much that we're going to talk about the specific carriers, right, but there's a trust factor selling to consumers now that we got a history of this now. We got some history. This is 1995 now. We've been doing this for a little while. Yeah. We have some history, and some carriers I know kind of give you a big first year, and then they kind of drop the numbers or the rates or the caps. I need a little bit more trust. I need a little bit more historicity so that I can feel good about it. I need to have a little bit of solace to take that client that the carrier is going to try their best to keep the caps or spreads or participation rates high enough.
Well, Steve, I understand what you're asking for. However, I will tell you that this is something the insurance agent really needs to do their due diligence on. The consumer has absolutely no way of finding this out. Mm-hmm. And really, okay, what I do is competitive intelligence. That's my handle. That's what I've done for about the past 15 years. So I'm out there looking for the stuff that isn't published. How do I tell if this guy's product is better than this guy's? And what can I use against this product to compete with it? I will tell you that in the past 15 or so years of doing that, renewal rates are the #1 most difficult thing to get your hands on. They absolutely are. So what did the company do to the caps in years 2+ on the product? Now, here's what I've learned. Number 1, there are about 10 insurance companies, I could count all of them on my 2 hands, that actually publish their renewal rate history.
That's it?
That's it.
There's 200, what is it,
244 index annuities, yeah. But we have had about close to 70 different insurance companies offer index annuities at some point in the past 17 years, okay? Out of all of those, 10 publish their renewal rates. And so insurance agents say, well, how do I find out about the renewal rates then? Well, my general rule of thumb is if you have an insurance company that doesn't publish their renewal rates, maybe you should ask why that is. I'm not insinuating that the renewal rates are not favorable, but if they were, don't you think they'd be shouting it from the mountaintops? The other really important thing to keep in mind is... Well, wait a minute.
And conversely then, the people that are doing it, are they shouting there because they're doing a good job at it?
Relatively good, yeah.
Okay, so, well, no, that's an important feature here that you said. From a consumer point of view, if you're listening, hey, what's the people that are PRing this, that are actually making public declaration, that to me, they're usually the ones that are doing a pretty good job on the next year reset.
Exactly.
Okay, well,
why would they be publishing it if it wasn't favorable? Right. But I will say, we do have some companies that have reduced the rates in years 2+, and that's not an illegal thing. All insurance products have both guaranteed and non-guaranteed elements, and as long as they stay within the range that they've told the insurance commissioner they'll stay within, they're fine. But the other thing you need to keep in mind is that we've had carriers increase their rates in years 2 plus. And I actually own an indexed annuity with a company that has done that before. Actually, 2 different companies. I own products that have done that before.
And if you're one of those 2 companies and you want to sponsor this show, let me know, because
and you know who you are.
And you know who you are, and you can call me 1-800-290-7226, my personal extension 127, and I will totally take your call.
Well,
wow, Sheryl, thank you for that.
No problem, Steve. Pay me later. But the general expectation is the carrier's going to keep the rates in years 2 plus the same as they were in year 1. Well, that's not the reality. And really, how do I decipher whether the company I'm doing business with is going to do it that way, or whether they're going to change them in years 2 plus? And really, the most simple answer to that question is, how does the insurance company distribute their products? If it's career or captive distribution, well, the rates when the policy sold are probably going to be the rates on the product 10 years later, because captive or career distributors really don't need to make sure that their products have shiny bright objects, because the insurance agent is selling their product with few exceptions. Are they selling somebody else's? Okay. And for that reason, the pricing is different. But when I'm distributing through an independent distribution, I need to have that shiny bright object.
Wow, and I can think of several brokerage indexed annuity vendors out here, carriers, who actually do have proprietary channels, career shops kind of. Some of them are a little bit different setup, but basically they are that way.
Yeah, captive.
That to me would be an issue, because I don't have to worry about maybe it is going to be is it better rate then? Have you seen historically? We just don't know. But that does bring up an issue like that. I mean, to me, that is something to look at. We're starting to look at what I can do for a consumer. Man, I may be looking at proprietary channels, that the carrier has their manufacturing of indexed annuities. They're going to have a little bit better history.
I want to kind of make a differentiation here too, though. There is another side of captive versus independent, and that's when you have lots of different choices to choose from, that drives competitiveness. Okay, so maybe the product that's offered by the career distributor is not the most competitive product. And in fact, I'll say a lot of career companies don't offer 10% premium bonus indexed annuities, even though those sell fantastically.
But by the way, I've noticed, am I missing that just to your point? I've noticed that more carriers are kind of drifting away from the bonus issue.
Well, they're dropping the bonuses. Just because pricing's so hard right now, and it's really hard to make your spread as an insurance company. And when you offer a premium bonus, and by the way, 70% of all index annuity sales have some bonus attached to the product, whether it be a 1% bonus or a 10% bonus. But that bonus is a risk to the insurance company. Back in the old days, we would have products where the bonus was so high that if the policyholder surrendered the policy on day 2, they'd actually make more than what they put in.
Those were the days.
People didn't think about that. I mean, we've had to learn our lessons from a product development standpoint.
I'm thinking the actuary who actually constructed that is no longer in the business.
Probably not.
I mean, think about that. I have a 10% with an 8% surrender charge. The guy could walk with a 2-point spread, and we still got paid.
Exactly.
I love that.
Well, and I have a lot of insurance agents who say, why wouldn't I sell this 10-year product that has a 10% bonus and pays 10% commission, which, by the way, that product is no longer available today. But it's like, hey, the insurance company's out 20% on day 1 between the commission and the bonus. You can't get something for nothing. I mean, they're going to have to accommodate and account for that 20%. But when you look at product development today, it's so different than it was when we first began, because we're more experienced. We are.
Well, we've been talking about issues just because I'm dealing with the trust me factor on the carriers on resets and annual. What are they going to do with these cap spreads and participation rates? They're going to change them. Have some carriers been more benevolent than others? I mean, I think people want to know these kind of questions. We're becoming more the baby boomer, my generation. We're becoming more Googleite. We're looking at it. We're researching everything we know. Now, let's get into, because I do want to talk about the show today. We're talking about, when we say the point-to-point really doesn't matter, you said all these other things about, well, how about the indices? Does it matter if it's domestic or foreign? Let's do domestic now. We'll go after the break, and we'll go after some foreign.
Well, this is the part where I say, Steve, remember, I am not a registered rep, so I can't necessarily talk to you about the securities products. But I will say this. We now have 19 different indexes to base your indexed interest off of on an index annuity outside of the S&P 500, okay? And we have bond funds, we have the 10-year treasury, we have the gold commodity, and we have domestic and foreign indexes. But none of that really matters. I mean, it is a great way of having some marketability and saying, hey, do business with us instead of this guy, because we offer some diversification on our product outside the S&P 500 or the Dow Jones Industrial. But when you look at, does that index necessarily offer additional consumer value over that other index? No, because when we go and buy the options from the option seller and give him our 3% of the client's premium to provide that index-linked interest, he's going to look at the history of that index and price his options accordingly so that his risk is relatively the same regardless of which index you're talking about. So,
well, then why again, I know we're not talking about securities here. We're talking about just basic trends in the life side. We have people that use 3 buckets so that, they take the first 2, they give you a little bit of percentage or ratio, and they drop the bad boy S&P. So let's say
the rainbow crediting methods.
Kind of like you have S&P, you have Dow Jones. Oh, but you could be in the Hang Seng. So you see what I'm saying? I mean,
yeah,
you have these
I
options.
do. Well, the basket methods or rainbow methods, or what some people call multi-index crediting methods, I've got 2 different camps. Number one, those that do a rainbow, where they look at, what was the best performing index over the 1-year period? What was the second best? What was the third best? And it might be a 5-year period or a 1-year period, but we're basically trying to see which index performed the best.
Right.
Well, then I've got my other camp where we're maybe basing the interest off of several different indexes, but we don't care who did the best, next best, what have you. We're saying X% is going to receive this weighting, or this index is receiving X% weighting. This index is going to receive Y%. Yes, so way in advance. And really, those crediting methods are a little bit tougher to price right now just because the interest rate environment and the volatility of the markets. And so the rates on those type of methods are generally going to be much less attractive unless you're using a long-term point-to-point or some long-term crediting chassis. But it really doesn't offer any additional value. And I will tell you, I have tons of agents and advisors who say, I really don't understand that. Can you explain that method to me? Because it sounds exciting and I want to present it to my client. Here's my advice to them. Yeah, those are great, because I have some agents who say, look, I don't know what's the best performing index. And this way, I don't have to worry about it because the company is deciding for me. Well, yeah, that's true. But if you don't get the crediting method, don't because the only thing you're doing is complicating the sale. And if you don't feel 100% confident in presenting that crediting method, what's the chance that your policyholder is going to have 100% confidence in you? My advice is keep it simple when it comes to your index crediting methods.
Well, I think we're going to do, when I have Sheryl back, we're going to do a set aside outside the business insurance zone. We have our new workshops that we're going to be rolling out in late April, early May. And we're going to start rolling this out because I think this is, they want to be taught, they want to be known. I want to put you on a whiteboard and let's get this done.
Woo! That sounds exciting.
It is. You're listening to the Business Insurance Zone, the talk show that focuses on insurance in your practice. You can email me at thebiz@brokersalliance.com or just call me toll free, 1-800-290-7226, 147 extension. Sheryl and I will be right back after a word from our premier provider of product right after this break.
Life doesn't always fit into 5-year increments. That's the standard for most term insurance policies. AG Selected Term offers you a powerful new way to help your clients customize their life insurance plans to anticipate known future events such as retirement, paying off their mortgages, or funding their children's college education. Buy only the term you need and no more. That's AG Selected Term from American General Life Company and the United States Life Company in the City of New York. Policies not available in all states.
Well, welcome back to the Business Insurance Zone. I'm your host, Steve Savant. I'm an insurance columnist, financial color commentator, and in my own mind, I'm an interviewer extraordinaire. Yes, and if you're going to move forward with anything on this program that you hear, always check in with your CPA, your tax attorney, or if you're FINRA licensed, always connect with your broker-dealer compliance department. How compliant was that? Hey, if you're going to talk about product on quotes or questions on life insurance, DI, LTC, group pension plans, or annuities, just call 1-800-290-7226, extension 147. It's not what I know, it's who I know. And that's why I have Sheryl Moore, industry-leading authority on indexing, on our show. And basically,
I'm learning all the mechanics of indexed annuities, finding out that if I hold it 10 years, it really doesn't matter anyways. I know that's an oversimplification of our 2.5 days, but really, when we think about it, Sheryl, we're talking right now for the rest of this segment. We're going to be talking about indexing because I do kind of like, and let's just say most of us are not an aficionado on indexing.
No.
Let's say we're not aficionado on options. That would totally be about 95% of our audience. So I do like the idea of having a 3 basket sometimes because I don't know I'm not a procrastinator. I am a procrastinator. I'm not making a diagnosis on where the market's going. So I'm not prophetic in that regard. So I sometimes I like that 3 bucket idea simply because it makes sense to me. Okay, I don't know if the America's going to do good with the S&P. I don't know if the Chinese and the Hang Seng is going to be the place. I don't know if the Euro 50 stock is going to be the play. I just don't know.
How about I play devil's advocate with you, Steve?
Well, can't we just be friendly and just say for healthy discussion's sake?
I think that that's no different than having an indexed annuity that has 3 different crediting methods. One's based on the S&P, one's based on the Hang Seng, one's based on the Russell 2000, and you put money in each of those crediting methods. How is that different?
1 policy fee.
There's
right?
no policy fee on index annuities.
I knew I could cheat.
Yeah. I mean, there's no such thing as
delivering
a policy fee on
1
an
contract
index
versus 3.
But it's still 1 contract. See,
I'm getting
the average
bonus on the comp if I sell 1 versus 3.
Steve,
I'm just trying to come up with an answer.
The average number of crediting methods on an index annuity today is 3.2. But we have some companies that have as many as 14 different crediting methods on one product, where you could say, I want some in an annual point-to-point, and I want some in a monthly point-to-point, or I want some in the Russell 2000 annual point-to-point, and some in the S&P 500 annual point-to-point. You've got a lot of choices, and most insurance companies offer more than 1 index crediting method. So you could duplicate what you're talking about effectively by allocating some premium to more than 1 index, more than 1 crediting method, and not have to worry about this complicated crediting method that I'm not saying it's complicated, but it's relatively more complicated, and some agents just don't understand how to explain it.
Well, I want to explain it again. I said before the break, we may have to actually have you in and do a whole workshop and really break out, unbundle, unpack this entire, we're trying to do it now. We're doing it. If you've never been out to Sheryl's site, she's got 2 sites, but the one we're talking about today is Annuities. 3 sites. Oh my gosh. What's the 3rd one?
IndexedAnnuityNerd.com, a totally free website with news and information about products.
Okay, that's Index Annuity
Nerd.
Nerd.
That's me. I'm the nerd.
.com. Well, I just think you're a substantial legal authority in the public domain. I wouldn't go nerd, but okay. But you have LifeSpecs for life insurance, but Annuity Specs. When we go on, we did the show. I just went to your site. I mean, you have all this stuff in here. I mean, it's huge, huge resource. If you're into annuities on a big way, you have to have this software. Now, this sounds like a shameless plug for Sheryl, but I'm just telling you, I don't know how else to collect the policy information. It's all there. Everybody that's a player is on this list. And this is kind of reminds me when we first came out, and no shameless plug for Vital Signs here, but when Vital Signs came out with their product, one of the biggest issues we loved was they distilled down a Cliff Note version of the policy provisions.
That's exactly what we do.
That was huge. I mean, I never had to guess anymore. I just dialed it up, there it was. And that's what we have over here. And I'm telling you, if you're an annuity player, if you're an advisor, and you're trying to really do your due diligence and your due care, which I totally think you should, this is a great piece. Annuity in, I got to get the site right.
Annuityspecs.com.
Annuityspecs.com, because the nerd threw me. Annuityspecs.com, and just go out to her site. It's a great program. The subscription is totally to die for. It's not that big. It's not that expensive at all.
Well, and I'll tell you, Steve, I do appreciate that you guys use Annuity Specs, but I don't know a lot of distributors that do competitive intelligence, and you guys do, and I appreciate that because it is important when you're looking at an independent agent distribution. But we have every indexed annuity available in the market today on Annuity Specs, plus any indexed annuity that's been available for sale. Maybe it's not even available for sale today, but your agent has an orphan policy holder.
Sure.
Any index annuity that's been available in the past 7 years is on the site. Plus,
wow.
Fixed annuities, multi-year guaranteed annuities, basically anything that's going to be selling through the independent agent distribution, we've got it.
Wow, that's huge. And I just can't say enough for the program. We are into the intelligence area. We are the intelligentsia of insurance products, and we do diligence at a high level. Our actual competition desk is called Countermeasures. It's a special ops marketing program. If I don't have time to get into it today, but if you have not seen it or tapped into it, you're talking about, serious intel on marketing steroids.
I respect that.
It is. We're into it. We want to know the truth, and we're trying to help it out. We're trying to collect some of the greatest data that's out there, and there is if you just really know how to hunt. We do now. We know how to do it now, and so we want to give that to our advisors and all of our participants and producers. When I'm looking at foreign and domestic, and there's always the what I guess I'm looking for, like the newest one I saw was like emerging markets out of Thailand or something. I can't remember exactly what country, but it is getting so exotic. And sometimes I think the exoticness or we're doing emerging markets in third world countries, and there's going to be a play because the growth is so unlimited because they're coming out of basically the 19th century and they're overnight going to the 21st century. There's some play here, right?
Sounds sexy,
It
sounds. You're not
does
going to
sound.
say that.
Listen, you already balled me out for the other word. Yes, it does sound appealing. It has a marketing appeal. It has exoticness. And it also plays the issue, if the United States isn't doing well that year, I could be into this. It sounds appealing.
It does. But remember, my option seller is pricing his options so that his risk is relatively the same. And I think a great example of this on index annuities is that we have a carrier who does offer 6 different indices on one product. Well, if you look at their annual point-to-point crediting method with the S&P 500 versus their annual point-to-point with the Russell 2000, the Russell 2000 cap's going to be less than the S&P 500.
Why is that, though?
Because the Russell 2000 has shown a higher propensity for gains than the S&P 500.
Why wouldn't I want to pass that on to my client?
Well, you would, but it's going to be relatively equal because the Russell is going to go up more than the S&P 500, even though you're getting a less attractive rate on it. The increase is going to be higher. The option seller is looking at it and going, well, S&P 500 has only gone up X percent, but Russell 2000 has gone up X percent plus Y. So he's going to price his options accordingly. And that's why I say, well, all these different exotic, international funds, even some commodities indices, not necessarily more value. Marketability, yes, but also keep in mind, we have a big controversy going on now at a state level, and certainly securities regulators are looking at this where they're saying, you've got an index annuity that has a commodities index?
Yeah, let's talk a little bit about that because I think a lot of our listeners, our producers, our advisors aren't hip to this. It's relatively new. So talk about commodities. Like, are we talking
gold?
Right now
we're only talking gold.
So we're not talking pork futures.
No, but I have had people who have proposed that, or even
How can pork futures be good for the pig? Hey,
okay. I'm from Iowa. We would respect that index on an index annuity.
So we're now, the commodity is heavy metal only, gold.
Right now.
Okay.
I have seen some filings for some products where they're looking at some other commodities. But here's the issue. A lot of regulators are looking at this because they're saying, whoa, I was cool when you were with S&P 500 because most people see what the S&P 500's performance is on the evening news. Almost everybody knows what the S&P 500 is. But now you're talking about a security, okay? Does that make this a securities product? No. And in fact, I've had arguments with the regulators saying, look, you can't make this a security product just because I'm basing the interest off of a commodity, because the underlying funds that back the product are still held in the insurance company's general account. There's still no risk to the policyholder, and it's being regulated by an insurance commissioner. But the argument is, yes, that's true, Sheryl, but you just told us 45% of all agents who sell index annuities are not registered reps. So what do you do when the policyholder says, now gold commodity, what is that? Can you explain that to me? Well, if you're not a registered rep and you try and explain it to me, you're giving unregistered investment advice. And so,
can I give unregistered investment education?
No.
So even education, even training to just look, to be able to speak to it may be an issue.
Absolutely. And at this point, I attended a meeting with the Iowa Insurance Commissioner's Office last month to kind of talk about this issue, because we need to be more of a self-regulating industry, in my opinion. And it's not that Iowa or the NAIC is saying, look, these might be securities. They're saying, hey, folks, make sure that these crediting methods are simple, easy to understand, and that there isn't a potential for giving unregistered investment advice. So we're talking about maybe having a registered rep available in the home office so that if it is an unregistered agent and the client asks that question, he can go out and call the home office and have that person explain it.
And they're good with that?
Yeah.
Wow,
They're good with
that's
that.
a good thing. I like that.
Or my proposition was, make the index company, if we're talking about the MSCI EM, have them create a brochure that explains what is this index, and you can give it to the policyholder.
I know we don't have much time for this show today, but I'm wondering, is anybody selling short? There was one company left. Has anybody got a short against the indices any left? I don't think there's anybody left anymore.
What do you mean a short against?
They were shorting. They had actually a side account shorting against the S&P.
Oh yeah, absolutely.
Are they still out there?
Yeah,
There's some out there.
Inverse annual point to points and inverse performance triggered.
Wow, I mean, they were all over it in August. I tell you, the guys were buying that short, and then a certain carrier on the life side indexing yanked their sub account.
Yeah, well, it's that sister company of this company you're talking about that has it on the annuity side.
I love that. They get you either way. Well, you can watch this show and all our shows in beautiful HD 1080p right on our site, www.brokersalliance.com, and on all our social networks, YouTube, Vimeo, Facebook, LinkedIn, and Twitter. And when you go out to www.brokersalliance.com, don't forget, that's that big red button, On Demand Video. Just click it. This is Steve Savant. You've been listening to the Business Insurance Zone. That's the buzz on the biz for today. Get in the zone, the Business Insurance Zone.
This has been a Bravo video event of the National Insurance Clearinghouse, the marketing arm of Brokers Alliance, one of the largest distributors of insurance products and services to a nationwide network of insurance professionals. Need insurance guidance? Call Brokers Alliance. The Business Insurance Zone, dedicated to financial professionals who use insurance in their practice.